Hey, Adam Hooksema here from ProjectionHub. In this video, I'm going to be walking through our garbage truck route financial projection template. I'm going to walk you through how to fill this out. And really, this is built specifically for those of you who are looking to raise capital, maybe from a lender. I'm trying to get maybe an SBA loan or raising capital from investors. And either the lender or investor has asked you for a set of projections for the business. And so we're going to walk you through how to fill this template out really step by step. Before I dive into the details of the template, a little bit of my background. So I was an SBA lender for 12 years, made about 1,500 SBA loans during my time as executive director of an organization called Bankable. Now today I own ProjectionHub and I'm kind of on the other side of the table helping people with financial projections, business plans, helping them through that SBA process typically. So today we're going to be looking at this garbage truck route template. I'm going to put a link in the description of the video below so you can grab this template and follow along. And also if you stick around to the very end of the video, as a thank you for sticking around and hear me ramble on about the spreadsheet, we are going to give you access to a discount code. So make sure to stick around to the end for that. Okay, so let's go ahead and dive into how this works. Okay, so I am on the at a glance tab. This is kind of the end of the process. So after you've entered in all of your assumptions and details on these other input tabs, this is the output. You'll get some different charts and tables and graphs that will be useful to throw into your business plan or put in an investor pitch deck. And then you'll get a 5-year income statement summary, 5-year cash flow summary, 5-year balance sheet summary, and then the income statement, cash flow, and balance sheet all broken down by month. Okay, so in order to produce all of these reports, we have a bit of work to do. We got to go through these input tabs and enter in our assumptions on these various blue assumptions. So the first thing you need to know is that any cell that's highlighted in blue is an assumption you can change without breaking something in the model. I'm just going to caveat right here that I know for some folks, Excel is a little bit scary. And so if you're at any point getting into this and you need some help, feel free to reach out to us at support@projectionhub.com. We'd be happy to try to help answer any specific questions that you have. And also, if you get into this and you decide, you know what, I just want someone to fill this out for me, or I want someone to customize this and fill it out for me, we offer a service that will take care of all that for you. So you can kind of just tell us your plans verbally. So this is what I'm planning to do. Here's the truck I'm going to have. Here's what I think is going to happen the first year. Here are the expenses I'm going to have. Here's what I'm going to charge. And then we'll just kind of take care of the modeling for you. So I just want to make sure that that is available. But I think you're going to be able to do this on your own with this template. So I'm going to walk you through how to do it. All right. So we're going to assume this is a startup garbage truck route company. So you're buying a garbage truck and you're going out and you're selling and trying to pick up customers, and it's an independent garbage truck, right? So we're going to say our starting cash balance is 0 because it's a startup. Let's say you're going to put in a personal investment of $50,000 here in month 1. Now, accounts receivable terms. So this is how long is it going to take your customers to pay you? So maybe the way it would work is you'd sign up a customer, you'd provide service to them for a month, then you would invoice them or charge their card after you've provided service. If on the other hand, you are charging them up front, then you could actually set this to 0. So like, let's say you charge them up for the month that is coming. We would want to put 0 in here for average days to receive payment. Okay. On the accounts payable terms, this is how many days it takes you to pay your bills. So let's say you're putting expenses on a credit card and then you're not paying that credit card for the month for 30 days, or your vendors are allowing you to have terms, they invoice you and you pay at the end of the month. Now, what I typically suggest here is maybe 15 days because some expenses you'll probably have to pay upfront, pay with cash, or some expenses you might be able to put on a credit card and wait, 30 days to pay. Okay, so here's where we're going to add in our fixed assets other than the trucks themselves. The idea here is we're assuming maybe you'll need a small storage facility that you're going to park the trucks. Maybe spend $20,000 on some initial leasehold improvements. So maybe you're not buying the building, you're leasing it, but maybe you need to make some improvements to the space to make it work for your setup. And so we've got a $20,000 kind of leasehold improvement expense here. And we're going to depreciate that over 10 years over the life of a 10-year lease, maybe, for example. And that's going to happen in month 1. Now, here's where we need to add our trucks. So we're going to assume that we have 2 trucks, one kind of rear loader truck, manual pickup for residential, and then one more commercial front loader truck. We've got purchase prices here. And again, you can adjust what purchase price you're going to use. We're going to assume that we'll use the trucks for 10 years, and then their salvage value after the 10 years of useful life will be basically 10% of the initial purchase price. So you'll kind of sell them for scrap at that point. And then we're purchasing those trucks in month 1. So we're going to purchase both of these in month 1. And then we're going to assume that we're getting financing for the trucks. Okay, so what we assumed here is we took the price of the truck times 90%. So assuming that you're going to put in a 10% down payment and finance 90% of the truck at an 8% rate over, and we may bump this out. These trucks will probably be able to be financed over a longer period of time. So let's say a 10-year term on those. Now let's say you also need an SBA loan for working capital because it's going to take time for you to build up enough customers to really reach a break even, and when you sell your first 50 customers and you're sending the truck out to pick that up every week, you may not be breaking even, but then once you hit X number of customers, you're going to reach your break even point. And so you'll probably need some working capital to help cover your labor costs and your operating expenses for the truck while you don't have enough customers yet to reach that break even point. So we're going to assume a $300,000 SBA loan over a 10-year term. Okay, so this little box down here is just telling us, yes, the starting cash is sufficient based on the assumptions that we have in here. And actually it's kind of saying, hey, we may not even need to borrow quite that much. So we could even bring this down. Let's say we're going to do $250,000 instead. And that still gives us room with some buffer in there as well. Okay, let's look at our input revenue tab. So here's where we're going to build up our customer base. And so let's assume for the residential customers, we're doing some advertising. We're going to spend $1,000 a month in ad spend. So we're going to assume $75 per new customer is kind of that customer acquisition cost. So if we spend $1,000, 75 per customer, that's going to give us 13 new customers a month from paid ads. And let's say we're also, working on organic sources and word of mouth, and we're going to get 15 new customers a month from word of mouth. And we have an annual growth rate of -3%. So the idea is that maybe over time it'll be harder and harder to get new customers because customers will have heard about us and it may actually get harder to bring on new customers. So here's our 28 new residential customers for the month. And we're going to assume that 100% of those new customers will become regulars, right? So we're not doing any like one-time pickup service. Like if you're signing up, we're assuming you're signing up as a regular monthly customer. And then here's your annual churn rate. So this is assuming 25% of your regular customers will cancel each year. Now this could be because customers move away and then you've got to sign up the new customer who moved into that house. Now that may be a bit aggressive. Hopefully you'd have a lower churn rate than that. Maybe we'll bump that down to 20%, or maybe it could even be 10%, depending on if your customer base is in an area where people are staying in their homes for a long period of time or whether there's a lot of churn or turnover in those areas. So here's your total regular residential customers, okay? And you can see that each month. Here's where we can see we can put the number of trucks. So we bought 2 trucks, right? On the other tab, we've got these 2 trucks, right? And so what you are going to need to do is put in the number of trucks that are being used for residential. So we're going to assume one of those trucks is used for residential and one is for commercial, and we'll get to that in a moment. Here's the max number of households per day per truck, work days 5 days a week, and then 4 pickups per household per month. So this is helping to calculate the max number of unique households that can be served with that truck based on these assumptions. So we're saying 1,500 is the maximum that this truck could handle. And so here we're going to make sure, the model is going to make sure that if you can't go over that 1,500, okay? So it's going to kind of be a checkpoint for you. Let's just say this was 100. Now we'd see this changes to 500 as a maximum. And so what we'll see down here is once you hit 500, it just maxes out it. That's all the customers we can have. Even though we're doing all this work to get new customers up here in the customer acquisition, say, nope, we only have 1 truck and the truck can only handle 500 customers. So it's limited to 500. So that's something you'll want to just keep a close eye on and make sure you fill out correctly. From there, row 41, you've got this total number of unique households or customers. And then we can break down the types. So you could simplify this and say everyone pays the same price. Every residential customer pays the same price. If you did have different pricing based on maybe do they have 1 trash can? Do they have 2 trash cans? Like how much are you picking up? So you could have small households, standard, large, or extra large households, right? With different price points. And then you can set the percentage of your services. So you're saying 20% of our customers here are small households paying $23 a month. Okay, from there, what we've done is we've set up all these various cost of goods sold, right? And all of these expenses are going to be set up as a percentage of revenue. So if you look at how the equation is set up, the cost of fuel is set to 0.1. So it's taking the price times 0.1. In other words, it's 10% of revenue. We're assuming you're going to spend 10% of revenue on fuel. We're assuming 22% of revenue on disposal, 3% on maintenance, 2% on vehicle insurance, and 40% on cost of labor. That's going to be your biggest expense. Now, if you are the owner operator and you're driving the truck, then your cost of labor could be nothing. If if you're doing all the work, or kind of depends on how you're planning to handle labor. Then we can just set a kind of an inflation rate of 3% annual growth rate and 3% annual cost increase. Then we go through the same exercise for your commercial customers. So again, we have some ad spend. Let's say it costs $200 to get a commercial customer. Maybe you're getting some organic customers as well. So same exercise. We have a maximum number of businesses that can be served per day. And then here's your different, you could put in the different types of businesses that you're serving, percentage sold, average monthly fee, and so on, right? And the rest of this is just calculations. So from there, we're going to go to our operating expense tab. So here you can set up some different operating expense categories up here. And then you can put your specific expense line items down here, but you'll be able to use this drop down and put them into a category. So the drop down will populate it with whatever expense categories you put up here. And so you can kind of categorize all of those. We're assuming here we're going to rent a facility for storage. We also have an expense as a percentage of revenue. So we're going to assume that credit card fees, credit card processing fees, maybe your customers are paying with credit card. And so we're going to assume a 2% cost for that, for the processing fees. And then the last thing here, we're going to have our salaries tab. So let's say you as the manager or owner are going to hope to make $70,000, but in the first year, maybe you can't afford to pay yourself. So we're going to start this salary starting in month 13, so the beginning of year 2. Then you're going to give yourself a 3% annual raise. Now, remember, if you are also the driver and the owner, we have built-in cost of labor here. So you could be paying yourself through this labor cost in addition to, whatever you'd be paying yourself as a salary. Now, if you're hiring out a driver, then, that labor cost would be really covering the driver, right? And this would be your only salary. Okay, so that brings us back to where we started. And so you can see, as I kind of played around with the assumptions, the first couple years, like I kind of mentioned at the beginning, you got to sell to be able to get up to that critical mass to have a full route. And that could probably take some time. You're probably not going to have a full route on day one. And so we can see that it ramps up, that revenue really ramps up as we bring on new customers. But then by year 5 here, where we have an EBITDA of double digits, low double digits here, which is kind of within the range of industry standard, but it can take some time to get there. So I think it's important to make sure you are well capitalized, or that you have a very good sales effort in line when you get started. Maybe you go out and you pre-sell before you buy that truck. You're pre-selling a bunch of folks so that you have a pretty full route ahead of time. Maybe you're giving those customers some advantage or discount for the first year if they pre-order with you before you buy the truck, and kind of sign up so that you have that built in. Okay, so I'm going to again put a link in the description of the video below to this template, but also as a thank you for sticking around to the end, we're going to put a link to a form that you can fill out to get a discount on this particular template. So make sure to fill that out and take advantage of that. And again, if you have any questions along the way, please don't hesitate to reach out to me at support@projectionhub.com. All right, thanks.